Testing.
Hello, how are we all doing? Can you hear me? Let's go. How are you doing, Kartik?
Doing well, sir. And you?
Phenomenal. All right, we're gonna get get some people in here. Wait a minute for the Kartik's.
Hello, everyone.
Hello, Jasmine. No, go for it, Jasmine. Kick us off. I'll go for it. All right, so Kartik, what's going on while we wait for who else is joining from your side?
Just myself from our side.
Just you. Okay, got it. Well, in that case, I guess we're good to begin in a moment. So let's see. Jasmine, are you with us now from the VDEX side? Are you going to be reading the questions?
GM everyone, thanks so much for joining us today. Let's wait just a moment for more people to hop in.
Sounds good. No rush from my side. I have been reading the Twitter feeds these days. I've been traveling for like the past 24 hours, so in between plane hops, I dial into Twitter and just doom scroll, and it's just there's just so much going on. It's crazy. You've got ETH kind of shooting through the roof. You've got the GMX hack. You've got a whole bunch of RWA tweet threads as well. It's madness.
I just got done with the big trip myself. I was doing the conference circuit. Where were you traveling?
Nice. Actually, I'm meant to be on holiday. However, my holidays are basically where the coconuts broadcast Wi-Fi, so I can kind of dial in with my laptop and churn through a few things, watching the kids splash in the pool. So I'm somewhere tropical. I'm kind of GMT +8 or so, something like that.
Okay. Very nice. Well, thanks for joining us on your vacation. That's dedication right there.
No problem. It's crypto. There's no such thing.
Yeah, I don't know what to make of it all. I haven't looked into the GMX hack yet, but it looks pretty crazy, very surprising from such an old and theoretically battle-tested protocol.
No, absolutely. It feels like there's no such thing as safe harbor these days. And from my understanding, I'm just kind of catching up on it, but it looks like it's something related to their cross-chain mechanisms because they were deployed on quite a few other chains from my understanding. But that's kind of surprising. I haven't used GMX in a very long time, since like V1. So I've kind of out of the loop. But still, I mean, 42 mil from a well-known protocol is big news.
Yeah, it is an unfortunate one at that, but well, that's crypto, never a dull week. All right, Jasmine,
Right.
are you ready?
Yeah, I am here. Can you guys hear me clearly?
Yes, I can.
So all right, let's get started. GM everyone, welcome to VDEX AMA. We are so thrilled to have you join us today. And our topic today is what makes you truly sustainable, and we got two incredible get to unpack this with you. So everyone, please welcome Jose, founder and CEO of VDEX, and Kartik, contributor list of Demether. So first of all, thank Jose and Kartik for joining VDEC AMA today. I will let you guys introduce a little bit about yourself and the projects. So let's get started with Jose.
Yeah, so longtime GGen, longtime trader as well. Currently trading right now, actually. Bitcoin all-time high. Let's go. ETH
Let's
is,
go.
around 50% all-time high. That's something. I'm the founder and CEO of VDEX, building the best PerpDex platform and building an omnichain one at that. I was talking about the GMX cross-chain exploit. So that's something right there. Kick it over to Kartik. Want to learn about you?
Absolutely. Yeah. Thank you so much for hosting me, guys. I know it's going to be super fun. So my humble backgrounds are in TradFi. I did the whole investment banking circuit through the usual white shoe firms like GS, JPM, Merrill Lynch, etc. I ran into a guy called Robbie Young, who is CEO of Animoca Brands. He kind of red-pilled me on the idea of Web3 on gaming. I tried to list a business in London. I failed. I gave up and begged for a job instead. So I got onboarded into crypto about 2.5 years ago, spent time on the Animoca Brands corp dev team as a VC and strategist, and then had an idea to spin up this DeFi protocol called Demether. And very happy to tell you more about it, but I can also pause there.
Amazing. Thanks both for your introduction. So now let's jump into the first question. In the blockchain space, there are so many vertical like DeFi, AI, GameFi, or InfoFi, and the list keep growing. So with the very first question, I want to ask Kartik. So, among a lot of vertical, why did you choose to develop a zero solution? And what specific problem are you aiming to solve?
Yeah, sure. Thank you for that. So in terms of like the verticals that we wanted to build in, I guess we sit at the intersection of AI and DeFi. So I don't know how to pronounce this. I prefer it DeFi because it just rolls off the tongue. DEFAI. But however you want to pronounce it, whatever this new paradigm is, we thought it just made complete sense. So first of all, I love decentralized finance. I think it's such a brilliant way of lowering the bar for the masses to onboard into wealth creation. Because ultimately, that's why everyone gets interested in finance, is because not all of us like to count numbers. The simple fact is we need to be involved in order to make long-term investment decisions, top up your ISAs, your IRAs, your 401ks, your pension funds, etc. And understanding it is very much a skill. With decentralized finance, you need twice the level of skill because it's filled with jargon, arcane ideas, things that are never published anywhere. There's no book that can cover over it, all of it, because it's an ever evolving space. So we came into DeFi originally to try and simplify things and give access to ordinary people to achieve maximum yield for the products that they wanted exposure to. So all of this sounds a little bit theoretical, but in a nutshell, if you wanted to hold ETH, then we want to provide you with a fantastically yielding liquid restaking token. So you just passively hold it and you take home double-digit yield. And then we launched the same thing with Solana called DemSol. So if you want to hold Sol, that's great. Why don't you hold a yield-bearing token instead, which is going to generate you fantastic yield. Now, what's happened along the way is a little thing called AI came up. And what was originally a cute little toy where, hey, you can vibe code certain aspects of your code base, or you can use it to create a funky UX, or better yet, you can, riff with it on ChatGPT and, it helps you to decompose a problem or ask great questions, etc. What we realized very quickly was the tools were way, way more powerful than we thought. And once you understand the idea of, composing your prompts accordingly, then amazing things happen. And the whole idea of having a 3 to 5 person startup with an AI backbone for infrastructure suddenly became a reality. So it's like seeing the sun for the first time, emerging from a dark cave. You're never going to go back into that cave and stare at the fire again. Like you want to see the sunshine. And for us, like discovering the full potential of AI was really like that. So it made sense for us to try and combine the technologies. And what was born in the past couple of months was Demether 2.0. We're producing a brand new product called Dem AI, which is going to be a fully automated vault strategy. You no longer have to do anything along the lines of minting a token, just deposit your dollars and other tokens that we're going to be supporting soon, like BTC and ETH. And we will do a lot of the heavy lifting for you, automate a lot of the processes using this amazing technology called AI. So that is why we are sitting at the intersection of AI and DeFi. And hopefully, as we start to launch our product, it'll become very obvious as to the benefits of that going forward.
I want to weigh in on the DeFi pronunciation. That's a new one, I have to say. I've heard DeFi AI, I've heard Def AI, I've heard a lot of things. That one's a new one. I think I'm going to use that. But on the question itself, so in terms of verticals, I think a lot of them are very frothy in terms of InfoFi and gaming, especially. There is a lot of very long-term promise there, but a lot of the protocols now are not doing something real. So I really like the way, Jasmine, you asked the question, what specific problem do you solve? And what and let me also get the pronunciation for and also for our audience, of course. Could you pronounce the protocol one more time?
Demether.
Demether.
So just to give you a bit of a background on why it's Demether, it's because Demeter is the Greek goddess of farming and harvest. And we combined that with the word ether because that was very much our background, developing apps on the EVM and Ethereum ecosystem. So it became Demether.
Love that. That actually makes a lot of sense. Very nice. What I like about Demether is that it solves a real problem, and it's a product that actually even I would use, and I'm very interested in how it works. And so let me know if I have this right, my understanding of the LSTs. So users can deposit, for example, USDC or maybe even Ethereum, and they're going to receive in return an LST that is effectively pegged to the base asset. So maybe one ETH, for example, or one LST of an ETH, but that is also going to be yield arbitraged in a variety of different sources. And I'd also love, and I think our audience would as well, to learn about what those sources are. Are they beta neutral? Are they risk-free? How exactly is this working? And then that gradually accrues additional value, so that an ETH holder is taking the appreciation of ETH, but also they're getting yield on top of that. And that is basically, having your cake and eating it too. Did I get close there?
Actually, apologies, I hadn't explained it properly. So we actually have multiple products. We originally launched our first product. It was called DemETH, and it was an Ethereum LRT. So very separate from everything else I also mentioned. And the idea was very simple. If you keep first of all, if you mint our DemETH, you deposit Ethereum on Arbitrum or Ethereum mainnet, and DemETH is actually minted on one of our partner chains. So that could be Tyco, that could be Superposition, that could be Arbitrum, Base, etc. And one of the reasons why we did it this way, it doesn't appear on the same chain, is because we wanted that value transfer from one network to another. So we went off and did a whole bunch of protocol deals with the foundations of these networks, and also with the protocols that sit in the ecosystem to try and give you utility. So what do you get from holding DemETH? You get much, much better yield. So a standard LST will generate you 2 to 3% yield by just passively holding it. We wanted to deliver 5% plus, and then juice the yield through our partner network, from incentives from the Blockchain Foundation, and also an airdrop from us. We then did the same thing with Dem Sol. So it's kind of an identical framework. You deposit Sol on Solana, and we will mint you Dem Sol on a Tyco, an Arbitrum, a Base, etc. So then you can use your Solana as one of the pristine assets out there in the crypto space in a much deeper ecosystem. So in Solana itself, I mean, there's very few protocols that have crossed like $1 billion of TVL. You can probably count them on one hand. There's very few that have a token value above 2 billion. It's a very, very small and nascent ecosystem, albeit very vibrant, very, very interesting. But if you happen to take your product over to EVM, that is a phenomenal number of chains, a huge number of incentives out there, multitude of different ways to farm. It just made a lot of sense to us that the asset can thrive in a larger ecosystem. So we created it such that whenever you mint our tokens, it moves over to a new ecosystem. Aside from that, we have begun development on an AI product. So that is where the USDC or USDT comes into play. And we want to open up to a broad range of different assets. We're not going to be tied to our own LSTs and LRTs. It's going to be as simple as you deposit any of the major asset classes that we support, and we will find a way to farm yield for it. So it'll come in a variety of ways. We'll give you different flavors of being able to generate yield, so you're always in control. For example, if you deposit dollars, you can choose between liquidity pooling, lending, yield stripping on Pendle, because we will swap your token into something that can generate significant value and place it into proven blue chip protocols. So as an example, you could take USDC, you could elect to putting it into a lending pool. We will find the best stable coin that can generate the best yield on the chain that you want to sit on, swap it into that, and place it into lending to maximize your yield. Alternatively, if you did something like a yield stripper or Pendle as an example, then, for example, we could swap your USDC into Level USDC or Athena and place it through Pendle to lock in a very high yield. But we'll be super transparent on what the outcome would be, the protocols that we'll use. We'll just get rid of all of the detail of having to deal with continuously interacting with the protocols below the surface. So it's about bringing the full effect of that yield to you without having any of the hassle of having to deal with it on a day-to-day basis.
Okay, that's making sense to me now. So there's two products. The first product is you for ETH and Sol, it mints on a different ecosystem, and the value is effectively transferred there. And then there's the second product that is AI yield farming on stablecoin. On the first product, As a builder and developer, I understand the benefits of it minting on a different ecosystem, especially Tyco. I know those guys well, and moving funds effectively from Sol to ETH to create allow access to bigger markets for that liquidity is valuable. But as a user, I wonder, is this something that they prefer? If I am locking funds, for example, on Ethereum, maybe I'm already familiar with the Ethereum ecosystem and I want my funds to remain there. And the same with Solana.
Yeah, oh yeah, absolutely. So I guess you have a different subset of users that would use it in different ways. If you wanted to stay within the Ethereum ecosystem, there are a huge number of pros to it. So you have a number of battle-tested protocols, blue chips out there that have kind of spun up from the beginning of DeFi, like 5 years ago. But you also have to cope with high gas fees and the difficulty of moving your assets around to new opportunities. So that is kind of the blessing and the curse. It's a double-edged sword. Whereas a lot of the fast moving money is typically cycling between different incentives on newer chains. So what we wanted to do was allow this experimentation on different chains by minting into different ecosystems. So we are moving money on your behalf, and you could take advantage of the higher yields, albeit with higher risk. So it was meant to play into I guess a demographic where they may have a lower amount of funds, say $50, $100. You don't have the tyranny of gas eating into your returns, but you can also participate in brand new, interesting ecosystems that are looking to give incentives to have people beta test their product and ultimately form that early stage ecosystem. So it was about playing into that narrative. And we started development over a year ago, and clearly narratives move very, very quickly, which is one of the reasons why we didn't want to be tied down to a specific product in a specific vertical where we had to put all of the human capital behind creating the partner network and developing a utility ecosystem around our product. What would be much easier is if we formed a meta layer that sits on top. We can take the assets that you want to hold and deposit, and we can move them around for you and also maximize the yield without having any kind of specific bias. So that was kind of the thought process behind the transition. But you're right, like it would appeal initially to a certain slice of the demographic who are after higher yield, albeit higher risk opportunities.
Okay, I think I get it. So it's effectively a bundled bridge and also yield token, and also specifically maybe for the airdrop audience that's looking to get access to these new opportunities, have an all-in-one capital efficient way to move their funds and access all of these opportunities. That makes sense. Okay, and for the second product, I have two questions. The first is, so is that yield beta neutral? And second is what model is running this ARB strategy, and how can users trust it?
Great, yeah. So I guess the neutrality of it depends on what you deposit. If you are depositing ETH and SOL, the presumption is you want to continue to have exposure to that. You're not just trying to mint a stable coin off the back of it, for example. If you're depositing dollars, of course, you don't necessarily want to take any directional risk. So we will kind of use that as the cue. If you are depositing SOL, for example, and you're putting it into liquidity pool, we'll have some very clear warnings that that's going to, potentially limit your access to upside and also downside. But for most other cases, it'll be pretty transparent as to what the user is trying to achieve. So why would they want to do this? It's the benefit of having all of the complexity stripped out such that you no longer have to watch it. So liquidity pooling is probably the simplest example I can give to kind of walk through. I wanted to have some kind of exposure to a token, and I felt that it was range bound for the time being. I would want to set up a concentrated liquidity pool. I'd want to put it into something like, for example, Airdrome or Velodrome, where I'm getting some kind of yield enhancement through the tokens above and beyond the fees that were generated. And I don't want to be watching it 24 hours a day in case there's some kind of spike and I need to rebalance or adjust my range. I want all of that system automated. Then that is the kind of user that would turn up and one click have exposure to liquidity pools without having to manage any of the difficulty. So the first question, I guess, would be, why would we bother to use an AI-driven service rather than just put it into gamma strategies, for example, or a whole bunch of others? VFAT is brilliant at managing these ranges on a concentrated liquidity pool. It's because they lack inference. So when there are significant spikes, or even short-term spikes, or even some level of volatility, you'd want to be able to train the AI to recognize whether that could be short-term, long-term, whether it's a structural shift in the direction of travel, and be able to adjust the range accordingly. And in the absence of that, you need human oversight to work out exactly what you want to do. So that's like a small example. It gets much more interesting when you apply it to something like Pendle. So automated things like that, you'd not only need to discern which assets you'd like to put it forward into, you'd need to understand which ranges at which you'd want to lock in yield, the maturities. So these kind of things can be set partially from users turning up and giving their opinions on how long they wanted their capital locked in, for example, if it's in a liquid pool, which kind of assets they want exposure to, and what kind of yields that they're actually looking for. Because at some point, I mean, you don't want to take on extra smart contract risk. You'd rather just park it in something that's giving you treasury yield instead of taking on 3 times the level of risk just to have another 100 basis points of yield. It just doesn't make sense in certain circumstances. So with things like that, we want to make sure that we are developing a suite of inferences that can help you manage the risk reward balance on a variety of different scenarios. In terms of the protocols that we'd like to put the money to work in, we would segregate the strategies first and foremost. So if you are putting an asset towards liquidity pooling, you know that it will stick to 1 or 2 different protocols that can liquidity pool for you. If you're putting it into yield stripping, it's probably only going to be 1 or 2. I mean, there are very few out there that have scale and decent liquidity, and it's an equivalent thing with lending as well. So we want to limit your risk such that you know what you're getting into. You can spread your bets between different protocols and methodologies if you want to, and you can concentrate them if you felt like doing so. So it makes sure that we're not crossing the line between discretionary fund management, but we're providing as much automation as humanly possible to make the user's life much, much easier.
That sounds very interesting. Yeah, and we have AI that have to manage portfolio and also manage risk. Thank you, Kartik, for your answer. And with the same question, I also want Jose to share a little bit about VDEX. VDEX is originally a perplex, but we also develop a zero solution. So why did you to develop it, and the problem are you aiming to solve?
So yeah, similar to the yield solutions over on Demether, VMM, Virtual Market Maker, is the yields vault on VDEX, and it is completely algorithmic so that we do not get into discretionary fund management. So that's, of course, not AI, but it is serving the same purpose with legal arb and ensuring that customer funds remain self-custodial. The way I think about the virtual market maker is that it's effectively a cartel of liquidity providers instead of together competing against perp prices on the order book. Everyone can pool their funds together, allocate them to this third party community managed vault, and the vault will earn the maximal amount of profit for all of them. This is what a lot of market makers do, but these market makers are closed sourced. They are using inside money, or they're accepting, financial deals by contract only to people that they know. And so it's very much a gentleman's club in that regard. The degen on the street does not have access to these opportunities, but they do with the virtual market maker. We've paid out 20% plus APR directly in stablecoins, not including any other rewards, over the past 4 months, and we're going to continue doing that. The yield is not beta neutral, but it is a positive EV on every hour, and that is paid out also every hour, or actually every 10 minutes. And that's what makes the opportunity profitable and very low risk compared to other opportunities. And what problem does it solve? Well, it solves the problem of being able to offer these opportunities to the masses, as they don't have access to these opportunities now. So want to move on to how, and especially this is very relevant for you, Kartik, how do yield mechanisms in DeFi differ from traditional finance? And both of us have a background. I'm not sure if you said specifically on Wall Street, but in IB regardless. Also, maybe you can tell us a bit about the culture differences and just speak to the broader differences in TradFi and DeFi.
Yeah, so in my mind, a lot of the mechanisms from Wall Street have bled through into crypto, except they are kind of masked in a different flavor, and they're definitely not kind of compliance and KYC or regulatory oversight. So you kind of get a positive and a negative. Stripping out a lot of that overhead means that anything goes. And you can have situations where you can have early access to like, incredible yield opportunities that you wouldn't otherwise be able to access as a non-accredited investor in TradFi. But equally, you don't have any of the protections that come along or with TradFi or the legal recourse as well that you'd have with a kind of registered legal entity doing business and authorized to do business in a given jurisdiction. So that's kind of the first difference that I'd like to throw out. It's not a situation in which we'd recommend everyone to get involved in DeFi. You should do your own research. None of what we're saying is financial advice. It's certainly for people who kind of understand what they're getting into and have a full appreciation of the risk. The second thing, however, is it opens up opportunities with different products in different asset classes and different scenarios that absolutely do not exist in TradFi. It may be inspired by the mechanisms that they've seen. They do not exist. And some great examples are what you can do with tokenized RWAs. If you take stocks, traditionally there's two broad classifications of stocks. You can have growth-oriented stocks, you can have value-oriented stocks, and typically a lot more of the value-oriented stocks pay decent dividends. And so people are happy to kind of park capital with the expectation that they're not overly volatile, but they are giving a regular return on a quarterly or sometimes monthly basis. Whereas if you take a tokenized equity and you plugged it into DeFi, you have an endless number of opportunities to generate yield on what would otherwise be a growth asset. And that is like a fascinating unlock that I think everyone should probably try to wrap their heads around. You can take stocks that don't pay a dividend and lend them out to another party that you may or may not know through a lending mechanism like Aave or Compound, whatever you like. You can then be a market maker, just like some of the largest entities in the world are yourself by plugging in that tokenized stock into Uniswap. You can then also do much more complex things without having to resort to option strategies, for example, by using something like Pendle to lock in yields. So there are so many kind of crazy combinations that can be applied to things that we know and recognize and can understand from a fundamental basis that have amazing unlocks as soon as you bring them into crypto land. The other side of the equation is there are genuinely brand new innovative products that have come out from DeFi itself as a completely native creation. One of the ideas is like the collateralized stablecoin. You can take a volatile asset like ETH or Solana or BTC, lock up more than you'd need, and borrow against that position as an over-collateralized stablecoin, for example, and then go off and use it in DeFi, knowing that its value would have some kind of parity close to $1. And then there are a whole bunch more clever things that you can do with that. You can put it into a yield farm that can, print you magic internet money that may or may not have value for the sake of providing liquidity and so on. Like the sky's the limit in terms of innovation, but a lot of these mechanisms are kind of the application or the creative application of what we've already seen in TradFi for many years. Sorry, have I lost you guys?
Nope, you're with me. Sounds interesting. I'm just getting Jasmine back here. We'll go on to the next question then. Oh, Jasmine, are you with us? Okay, I'll go for it then. What are the next key factors? What are the key factors of a successful yield model? Well, I'll go for this one. To me, in the virtual market maker, I would say that there's two variables that you have to consider. There's, of course, beta and alpha. Beta is the risk and alpha is the return. And so, of course, higher alpha is what everyone wants. but most people do not consider beta properly. And so when there are stable coins with triple-digit yield, people think, oh, this is a great deal. I'm going to get so much yield. But in fact, this is coming at the cost of very high risk. And that triple-digit yield sounds good while you have it, but it will not last forever and will eventually crumble. And that's why alpha is important to consider in terms of beta. And so what key factors make a successful yield model? Well, I would say it's number one is just transparency in what the alpha and beta are. So if you're a very high risk yield source, there's nothing wrong with that necessarily. But if you have to be transparent with that. You can't cover up that it is a certain risk when in fact actually it's higher. Second factor is leverage. Yield sources should not be over levered or it's going to blow up. And so that's a key consideration as well. You could have a low beta strategy, but levered up, it becomes a high beta strategy. And overall, I would say is sustainability. And that's, of course, the title of this space is all about sustainability. We're going to get into that further in a bit, but I'll just say briefly now that sustainability means that, well, the yield source cannot be inflationary. It cannot be coming from another two token model that mints one and burns the other. Anytime there's some source like this, it's likely that the model is not sustainable and is going to run out. So with the virtual market maker, the profit yield comes directly from fees, from net liquidations, and from arbitrage of the funding rate. So you know exactly the yield you're getting now is real. You can take it home today in stable coins.
So yeah, that's an interesting take. Kartik, would you like to contribute to the question?
Yeah, I'm so sorry. So I had lost my connection for a few seconds. So I heard most of what Jose said, and I 100% agree with it. Like the time of the inflationary token model is long gone. I think there was a good reason for it. It's because in order to kind of scream over the rooftops of a highly crowded DeFi space, a lot of people were willing to sacrifice what they thought didn't necessarily have a tremendous amount of value, their token, and sacrifice it for the greater good of trying to kickstart that flywheel. And I think it's been conclusively proven now that that is not the way that you can really prime the pump in a business model. And people really have to innovate a lot harder rather than kind of relying on lazy tokenomics in order to sustain that mechanism. So in my mind, I guess we kind of subscribe to everything you're saying. The only problems that we have are you are still at the mercy of what the protocol is doing in order to generate that yield. So we as kind of capital allocators or orchestrating capital moving between different protocols have to be absolutely mindful of that. Yes, I think there is a time and a place for inflationary mechanisms to be exploited, but it's going to be to the detriment for sure of that protocol. And we are not against kind of enabling our users to be able to have some kind of benefit from some of the larger protocols doing things like that, because you feel that even if it's short-term going to have an impact on supply and demand, you still probably want to have ownership of that token over the long term through multiple cycles. So for example, if it's coming from like a liquidity incentive scheme from a major chain, great example right now is Binance. So all of Binance's activity being pushed through PancakeSwap, which has seen an absolutely exponential growth of activity. I think they've cornered like 2/3 of all DEX activity in the past couple of months that Binance has run the program. Do you want to take a bet on the direction of Cake and PancakeSwap? No. Would you like to scoop up a handful of, one of the top 10 most valuable tokens out there? Absolutely. And if you can get access to the Binance Launch Pool and peripheral benefits like that, then it's certainly beneficial from a user perspective. The second thing that you don't have control or any kind of directional idea on is what happens to aggregate liquidity. So as the cycle ends, and we all know it eventually will, and even if it doesn't kind of crash and burn like it has in previous cycles because of the institutional bid, that liquidity is eventually going to seep out through some macro factors. And when it does, then yields start to fall in certain protocols, and activity generally starts to wind down because people look at risk reward and they may allocate their capital outside of crypto into other areas. We're not massively worried by that. I mean, it's something that you can't control. It means that capital and yields and interest rate risk will kind of move up and down. But at the end of the day, the institutionalization of the space means that more real world assets will come through. You'll have treasury-backed securities on chain. You'll have stable coins that are yielding because of the underlying collateral that they hold. You'll have stocks, you'll have real estate. And I think the entire space will become much, much more rich on a longer term horizon. So we as capital allocators are going to have to do the inevitable, which is to rotate. And that is basically the only way I think you survive A, the narratives and the way the space is evolving, and B, the fact that macro will have an impact that you can't control.
Okay, that makes sense. Yeah, I like that. I like that a lot. Well, kind of conceptual. Yeah,
Yeah,
go ahead.
yeah, that makes complete sense, and I really love the examples you brought up, Kartik, about pancakes. Uh, so, uh, so like, how is Demeter specifically solving the yield problem? Like, can you outline some bullet points around it?
Yeah, sure. So I think access to yield is actually shockingly easy, right? You can do it in TradFi. You just go and buy a dividend stock. That's like it's as simple as that. Or you buy a bond, or you put your money into a money market fund, and you have access to safe yield. It can have delta exposure. You can be exposed to the S&P 500 moving up and down, or that specific stock, or you can put it into something that has much more diverse exposure. You have the luxury of choice. But the problem with all of this is that it's so mundane, right? I mean, the best you can possibly do is mid-single digit. That's on a very good day in a very boring stock that may also see some sell pressure because it is so boring. How do you get racier exposure? You can get into option strategies, you can put money behind structured products, but the problem is the vast majority of people that do barely understand what they're getting into and can't manage the risk, especially when you're trading in assets and markets that are outside of your time zone. If you enter crypto, the norm is having access to double-digit yield. I think we can comfortably say that. Like each of us on this call can probably name 4 or 5 options off the top of our heads of different protocols, either sustainable or unsustainably high yields that can generate you far, far better yields than TradFi. But the issue is, of course, this comes with a tremendous amount of risk. So in my mind, or in our minds collectively at Demether, we want to provide people with access to double-digit yield without taking on the massive excess risk. Because the fact is, the human mind can't estimate time, weight, and risk very well. You need to be able to measure that in an objective manner and manage it in an automated or kind of professional way. So we have opted for a bunch of methods that are easy to explain, such as lending, market making, to an extent, like yield farming / yield stripping. That's not that easy to explain, but people kind of get the idea of locking in a certain yield for a certain period of time. And we leave it to them as to what they want to take exposure to. So all of the complexity is just in the choice that you make of whether you want to own specific stablecoins or ETH or BTC or SOL in future. And that's it. Everything else we can kind of manage for you. And the selection process behind the different strategies is typically from the level of yield that you see. Because on any given day, yield stripping may be massively better than liquidity pooling, which may be terrible compared to lending. But the problem is you don't want to manage the complexities of executing these strategies. You just need to decide between them. And that's where we draw the line between acting as a discretionary fund manager versus someone who's providing a technology platform and software that can help you automate it. So just that leap over the chasm of complexity and risk is what we are delivering with Demether.
That is interesting. Thanks a lot for sharing that, Gabriel. Not sorry, Gabriel. Kartik. Oh man. Question is for you, Jose. So, what makes VDEX yield model stand out from competitors in this crowded space?
Well, if you're referring to VDEX as the protocol, then there's a lot. I would specifically point to the fact that it's fully self-custodial. There are not 21 validators in a single location like Hyperliquid. It is omni-chain. Users can deposit from one chain and withdraw on another. It's sub-millisecond finality, which is 200 times faster than our competitors, on the same level as Binance. But if we're speaking specifically about yield, then I would say the biggest benefit is the fact that we take Bitcoin margin. So we offer sustainable Bitcoin yield, sustainable Ethereum yield without sale. So other protocols can take Bitcoin, Ethereum, for example, Babylon being the most famous, directly and without sale. However, if you go to other platforms, for example, WBTC on Aave, you're going to get 0.05 or 5 bips worth of yield. And on Babylon, it's closing in single digits now. And so Bitcoin is the only $1 trillion asset class that does not have a source of yield. Of course, real estate has rent, bonds, treasuries have their own yield, stocks have dividends, and so on and so forth. Bitcoin doesn't until Babylon, and there's a lot of liquidity that is looking for yield, and so there's going to be a lot of opportunities. What we do is provide a sustainable source for that yield using any collateral at 1-to-1 par collateralized ratio, and again from any chain. So I think also like Demether, we value accessibility.
That is good. This reminds me of the 10,000 BTC transfer the person did after 14 years. I think he should put his funds to good use. uh, so that brings up us to the next part of the space, and that is question and answers from Pretty. Uh, yes, everyone who has a question, please raise up your hand. I'll invite you, and then you can ask whatever question you have to Jose or Kartik or both of them.
Yeah. So any questions we have? I'm actually going to begin with my own question because I've been thinking about it, and well, I wonder why, Kartik. I understand the difference on the two products, the AI stablecoin yield arb and the LST model. I wonder how these can be combined in any way, and if there could be any improvement from sort of merging these systems, reducing beta in one when maybe the LSTs are more volatile, or somehow benefiting from that. And of course, anyone else, if anyone else has any other questions, please raise your hand, and we'll bring you to the stage to ask your own questions to myself or Kartik from Demether.
Yeah, thank you for that. Absolutely. So yes, we do think there'll be an eventual synergy. So why have we kind of set this up in such a weird, disparate way? It's because the original intention of Demether was actually just to churn out a series of yield-bearing products. So in the first iteration, they just exist as LRTs. In the second iteration, what we wanted to do was something a little bit more dynamic with the collateral that we're holding. So if we take DemSol as an example, instead of just holding the Solana sitting there on Solana mainnet and then minting a derivative or deposit token into another chain, why don't we put that Solana to use? So inherently, of course, it's being staked and restaked, generating like 10% yield. But if the restaking yield were to decline, why don't we open up other options, such as just withdrawing some of the SOL and placing it into Camino or something like that on Solana mainnet? So it becomes a little bit more dynamic. The SOL as an asset could rotate between different other protocols under the hood, and we could do the same thing with DemETH. What we discovered along the way was AI could help us fast track a lot of these processes and also completely open up the platform to make it such that we can accept other types of collateral as well outside of our control, like better name, better liquidity products like stablecoins and others. So the eventual synergy would be if someone comes along and deposits SOL, why wouldn't we just in the background mint our own Dem SOL for them to just park the assets in our vault before they're investing? So say they parked it for 3 months to work out which direction SOL was heading in and then wanted to put it into a liquidity pool. For that duration of 3 months, the SOL is doing nothing. So if it's instantaneously swapped or minting Dem SOL, then not only are we kind of increasing the level of revenue that's coming into our treasury because the user's now holding Dem SOL, but it would also give them a productive asset that's generating yield. So we can actually form a fully integrated stack by operating the AI vault that is maximizing yield of those assets, and also using our own assets as the intermediary step before the investment or between investment kind of deployments.
Okay, no, I appreciate that. That makes sense. So that's something that that users can look forward to. I think certainly the questions I had going into this space were about risk management, and so that that makes sense. Okay, very good. Let's see. Well, as we wait for some audience questions, let's see. Well, I guess
Actually, I
another.
did have a
Yeah, go ahead.
Yeah, I had a question for you on risk management, actually, Jose. That was great timing. Great minds think alike. I really wanted to kind of understand how you guys are picking and choosing the assets that are exposed to users within your protocol. Because you mentioned Babylon as your chosen BTC asset. Is that right? Do I kind of understand that you are, so if someone is depositing BTC or wants BTC exposure, Babylon would be the platform of choice to be able to deliver yield, and then you guys would further enhance the yield.
No,
So how are
actually,
you
so I
managing
was just
asset risk?
using Babylon as the sort of
Perfect.
benchmark, risk-free rate, if you would, for Bitcoin yield. Not that it is risk-free, but no, we take multi-collateral. So users on any of our chains can deposit any collateral from ETH to Bitcoin to USDC, USDT, and of course, we're always adding more as well. So we highlight Bitcoin specifically because it's very unique to us. It's our USP.
Got it. Okay. So I presume it'll be like a very small subset of assets that you would want to introduce as collateral. They'll be diverse, but they won't necessarily be like every different type of Bitcoin derivative product, or could it actually be that diverse?
Yeah, it could be actually. So it won't be infinite, but it can be diverse and effectively limitless because we don't take bad debt. So their mechanism is specifically allowing the basically regular settlement of collateral held by one token holder to another. So this works on the collateral basis. So let's say that USDC holders have some claim over USDT, then we can using our virtual rollups, which are zero gas, we can rebalance that instantly so there's no bad debt created. And we can do this also omni-chain. So that's one of the best, I think, sort of invisible advantages that we have that that people don't think about too often, but that does allow us to introduce a multitude of tokens without any compromise.
Very nice. Thank you. That makes perfect sense.
Yep. So we have a question by Tammy in the comments. The question is for both of you. How do VDEX and Demether enhance the user experience? I mean, sustainable yield is definitely important, but in order to uh, give the complete package, you also need to focus on user experience as well, right? So, how do you strive to do that?
I really like that question. It's been such a hot debate for many, many, many years. Like crypto UX sucks, right? And I can kind of, make that much more visceral by highlighting the three biggest categories in DeFi, which are swapping, staking slash restaking, and lending. Every single one of the major protocols has an absolutely identical UI and therefore UX, pretty much, right? One kind of bleeds into the other. And it's not just that we have zero imagination or creativity, it's that we're trying to appeal to a very specific class of user, which is a degen. Because the degen whales are the ones that have the most collateral and so can deposit the most TVL and generate the most revenue. So all of that has absolute alignment. What it doesn't provision for is the fact that this cycle, I think I can boldly say we've moved on. Like this is the point at which everyone from the political landscape through to regulators, through to mass market users and fintech and TradFi platforms have actually latched onto the idea that, hey, crypto is here to stay and it's time to invest some serious dollars behind getting directly involved in the ecosystem and not just playing at the periphery in the kiddie pool. So now we all have to kind of completely revamp for the mass market, real normie users. So how do we do this at Demether? We take like a 3-step approach. I think I've gone through automation very clearly. Like no one wants to deal with the hair-ripping nature of interest rate and maturity risk on Pendle. What we want is the double-digit yield, and that's what we strive to give them. But yield is all about utility. The UX comes from the fact that you don't have to intervene. The second thing we do is abstraction, which I think I danced around, but I didn't make super clear. So if you are depositing $1 and we say the dollar is USDC, we don't want to ever represent any dollars that we're holding on the platform as anything other than dollars. So why am I saying that? It's because if you and I had $1 in Chase in the US and the other person had $1 in Bank of America, those dollars are the same dollar and they're fully fungible. In crypto, if you had $1 of Athena tokens staked or unstaked, and I had $1 of DAI, they couldn't be further from the same dollar. Like the mechanism is completely different, redeemability is completely different. Like, the utility of that dollar is completely different. It is a vastly different landscape. So we want to smooth the abstraction from chain, gas, wallet, all the way down to the asset where you don't have to care. And if we tell you that you have X dollars, you really do have X dollars. We're kind of managing the assets in the background in order to make sure that you have maximum redeemability on those dollars. And then the final thing is the UI redesign. So we don't want to stick to 2 boxes where you type in a number and then you can hit max to empty out your wallet and it kind of converts into another random number. We'd like to try and make it really meaningful. So instead of some convoluted unwind process where you have to go through 15 steps and pray that you have enough gas and all that kind of stuff, it should be seamless. For example, and this is one of the ideas that we're toying with, why don't you drag an asset from your wallet into a strategy? You don't have to care like which chain the strategy is on, which assets are being deployed if we're swapping between them, as long as it's kind of giving you approximately the same exposure. And secondly, you can one-click unwind. So drag your asset back from the strategy into your wallet, and we will return the funds. It should be that seamless, and we're working really hard to make that happen to greatly enhance the UX.
I like the analogy with the dollar in 2 banks is the same dollar because it's backed by the same issuer, but the issuers on chain, not only are they different dollars in different places, they're different issuers, so they're fundamentally different dollars. I think that's a very good clarification for the current bifurcation and fragmentation of liquidity on chain. And for VDEX, how do we improve user experience? The first one being omni-chain. So users should not need to care what chain their product or yield strategy is on, and we allow that. We're completely agnostic. Once you're depositing into VDEX, you don't even have a distinction on the front end, at least on what chain you deposited. It's actually a nice thing about chain abstraction. Many people are scared of chain abstraction because they're like, whoa, I don't want my 1,000 USDC split into 10 different chains with 100 each, right? That's not something that the average Ethereum depositor wants. However, with VDEXs, or more specifically the virtual rollup version of chain abstraction, you do not need to make that compromise, and your deposit is held on the chain you deposited on and always in your preferred chain. So it's very much meeting the user where they are. And other user UX improvements, 0 gas fees. So users can deposit from yield to deposit to other products, pay, send, trade on VDEX, lever up, 10x on Bitcoin, whatever their heart desires, all without gas fees. And so that's pretty special as well. And one of the few big benefits that we offer with user experience.
Nice. Actually, I had a question that I completely forgot to ask about earlier in your intro. Are you guys using any specific omni-chain technology, like a layer 0, Axelar, IP, something like that? Or is it completely proprietary?
Yeah, it's completely proprietary. I've spent the last 3.5 years building it. It's called virtual rollups. The primitive is the zero knowledge state channel. So if you're familiar with Lightning, we basically allow the users to perform their own state transitions, and that allows a fully trustless atomic swap from chain to chain.
Amazing. Sounds phenomenal. That's an incredibly hard piece of infra to develop internally, for sure. I mean, we shopped around between so many different interoperability protocols before we settled on layer 0. It made sense because previously at Animoca Brands, we'd overseen multiple investments into layer 0. We'd kind of vetted it thoroughly and tested it. There are a whole bunch of other big protocols that had adopted OFT20s as well. But that's not to say that we couldn't evolve going forward. We're looking very closely at Chainlink, for example. Yeah, it's definitely the way forward. There's no question that the future is going to be omni-chain without that limitation.
Yeah, for sure. People just want to interact with dApps and get their problem solved. They don't know which chain is running underneath. So yeah, that was a great space. Thank you, Jose. Thank you, Kartik, for taking out the time and doing the space. Thank you, everyone else, for showing up and contributing to the space, listening in. Hope everyone is taking home some great insights on makes yield truly sustainable, right? Yeah, hope everyone makes some bags with yield. Okay, everyone, and
Great.
see you next time. Thanks, Kartik and Jose.
Pleasure
Yeah,
talking,
thank you so much
Kartik.
for hosting us. I really enjoyed it.
Sustainable Bitcoin yield. See you guys later.
Yep. See you, everyone.
Thank you. Take care, everyone. Bye.